Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Saturn Oil and Gas Inc. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with Saturn Oil and Gas, please click on the Meetings tab found on the left navigation bar. You will be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Kevin Smith, Vice President of Corporate Development of Saturn Oil and Gas Inc., which trades on the OTCQX Best Market under the symbol OILSF and on the TSXV under the symbol SOIL. Welcome, Kevin.
Great. Well, thanks for having me. And thanks for everybody to take some time to learn about Saturn Oil and Gas. We are based in Western Canada. 100% of our production here is in the prairies. Most of it takes place in the farmers' fields here in Canada's breadbasket, and of course the heart of Canada's oil patch. Canada's had enjoying quite a resurgence now with the high oil prices that we're currently enjoying now. So currently now the cash flows are very strong for most of industry, and Saturn's been enjoying a pretty rapid growth rate during this period. Our home exchange is the TSX venture, and we've just recently launched onto the OTCQX in September, just a couple months ago now, and having a great pickup in volume and seeing quite a bit of interest from U.S. shareholders onto the opportunity that's available in the energy markets here in Canada. For most of you, I would be quite certain this is the first time you're learning about Saturn Oil and Gas. We've only reached the radar screen of most serious investors in the last year. As early as Q1 of 2021, just last year, we were doing about 233 barrels a day of oil production. We've now increased that to where we're now through 12,500 BOE a day of predominantly oil production. About 96% of what we produce is crude oil and natural gas liquids. The other 4%, a small amount of natural gas that we do produce, but we're more focused on the oil side because the oil is where the high oil prices are, the high netbacks, and certainly the high wellhead pricing. So we're as a young emerging company, we're budgeting and forecasting roughly $250 million of EBITDA for next year. That's coming out of the large oil properties that we've acquired and been developing in the past bit, and a couple transformational acquisitions. And I'll walk you through our most recent acquisition. You can see how impactful that's been for our shareholders. But we currently have roughly 1,500 square miles of land where we own the mineral rights to here in Canada. Very big land spread. We're about 500 drilling locations that have been booked, and really at our current pace of drilling, probably 15 years of drilling inventory to kind of keep us busy with the number of horizontal wells we've identified for future growth and future development. So as we tell our shareholders, it's been a pretty aggressive growth for the last 18 months, but at Saturn here, we're just getting started, and I'll kind of dig in here to kind of what our strategy is. So we are a junior oil and gas company. All these are in Canadian dollars. Of course, we have 60 million shares outstanding. We're trading at roughly $2.60 now Canadian. So that puts us in about roughly $150 million market cap. And we have taken on some acquisition debt, and I'll kind of walk you through how we do acquisitions here at Saturn. And so what we do though is when we acquire these assets, we use the cash flow from the assets obviously to pay down that acquisition debt. And we're paying that down quite rapidly. About 50% of our cash flow goes to paying down debt, and the other 50% goes to the drill bit to increase production year over year. So we currently have about $230 million of net debt, looking to get that down closer to $200 million, $215 million by year end. And with these, we're making principal payments every month, roughly between $12.5 to $13 million on a monthly amortization. And so by sometime in about 2 years from now, Q3 2024, we budget at this pace of debt repayment will be net debt to zero. So we are, here's a little map of Canada as a reminder. We're in the western half of Canada in the prairies, and 100% of our production actually comes from the province of Saskatchewan, where it's mostly an oil-bearing province. And a very important consideration is in Canada, the mineral extraction rights are governed by the provinces, much like in the US, where the states control each of their own oil and gas markets. So it's very important here to know that Saskatchewan has some of the lowest royalty rates in North America. Certainly within Canada, it's one of the better provinces to operate in. The government's very supportive of extractive industries. That includes potash, mining, certainly oil and gas, big part of the economy. So the royalty rates are quite low, and they haven't changed in decades. It's something a little bit different than some of the other provinces. Certainly, we're based in Alberta, in Calgary, which would be the heart of the headquarters for oil and gas companies. But we're focused on Saskatchewan, and we're now the 9th largest producer of oil in the province, and we've got our sights on getting into the top 5 here. So this is I want to walk you guys through the Viking acquisition. We just closed this on July 6th this year, and it was a game changer. It really pulled our company to the next level. We acquired it for $240 million, was the cash acquisition price, and it brought in 4,000 BOE a day. 98% of that's light oil. It trades at a very good premium here in Canada. Slight discount to WTI, but it'd be very similar in nature to the light oil that WTI is. So if we were to sell this in Cushing, we would get a very similar price to what WTI is. We'd probably get somewhere around an $8 discount because it's still here in Canada, but still very high sales prices. And we get the benefit of a strong US dollar. All of our costs are in Canadian dollars, and with a recent 10% tick up in the US dollar exchange rate to the Canadian dollar, it really helps us, in increasing the oil prices that we get. So we've been enjoying very high prices here. $200 million of this acquisition was financed by our capital markets partner in New York. We have a family office that's been lending to us for our last 3 acquisitions. And so they stepped up here really quite nicely to finance 80% of this acquisition, and that keeps the number of shares down. We did do an equity offering with a Canadian bank that did a bought deal underwriting for us, where they put up $65 million of their own capital so we could make this acquisition. And then they went to market, and when they did go to find investors for this financing, it was oversubscribed. I personally invested in it, and so did every member of our executive. In fact, important to point out, right up from our CEO level down, all executives have invested in each of the last 3 equity offerings, and I think that's important for us that we stand shoulder to shoulder with our shareholders. We're basically have a very similar mindset of how we're going to get to. So the big offering came in, and the largest shareholder was Pender Fund out of Vancouver here, a Canadian mutual fund manager. They put up $11.5 million as a lead order, and they've been a shareholder with us for a little while now, and they had a chance to take a bigger bite of Saturn too. So we're happy to have them involved. Probably 65 to 75% of the book was institutionally based. So we had a number of new institutions came in, and some from New York, Australia, Canada, US, all over. So some big expectations, but certainly I'll walk you through how this Viking acquisition really made a big impact to our company. So we had the pleasure on November 8th. We put out our 3rd quarter financial report. This deal closed, to remind you, on July 6th. So in Q2, there was no impact from the Viking acquisition, and then it was fully integrated into our financials for the 3rd quarter this year. And you can see just outwardly change quarter over quarter, a big impact for the company. So production went up 50%. That was fantastic. That got us close to 11,000 BOE a day for the quarter. That's up 50%. Revenue was up 53%. But the big impact is we were enjoying high oil prices, but how much of that cash flow do you keep from every barrel that you produce? In Q2 of last year, sorry, Q2 of this year, we were getting roughly $30 Canadian as a cash margin for our oil, and very good margins for ourselves. With the impact of this Viking acquisition, our margins went up to $50 per barrel. And this is a function that the Viking oil that we acquired had very low royalty, only 5%. That's roughly a third of our legacy royalties, closer to 16%. Our operating costs on the new Viking acquisition are roughly $5 per barrel, sorry, $15 per barrel. That's about half of our legacy production costs. So production costs came way down, average royalty rate came down, and so as a result, the margin per barrel went up by 70%. Really changed the profile of our cash flows on a per barrel basis. Now, where that turns into is EBITDA on a cash flow basis. We printed $18 million of EBITDA in the second quarter. That was a record for us. We're delighted with that. It was up 170% onto Q3. So we are getting roughly $50 million of EBITDA for that 3-month period. You can annualize that to 200 million and get a good idea of kind of what the cash flow generation power is of the assets that we put together. And I'll touch on these assets here quickly, but we also did an equity offering. So more importantly, on a per share basis, our cash flow per share in Q2 was 45 cents. The creation of the deal took that up over 50% to 69 cents per share Canadian for that 3-month period. I'll remind all you guys, and you're probably aware of it, that Q2 was the height of the summer oil prices. The average price for WTI was $108.41, and that's we're down about 15% here in the third quarter. It averaged about $91.58. So even with the declining oil price quarter over quarter, we're able to print some pretty big gains on the cash flow side. We had the bought deal in hand on May 31st when we announced the Viking acquisition, and we had the debt lined up from our family office in New York. So the acquisition closed on July 6th. So we went into the market in the first 2 weeks of June and started layering on some hedges. We certainly were buying this at about 1.8 times cash flow, and the expectations are the cash flow will pay off the acquisition debt. End of the day, our shareholders own the asset 100%. So we locked in about 2,782 barrels a day for the last 6 months of this calendar year. So we got $102.65 as a locked-in price. That's fantastic for us. Even into next year, 2023, we took roughly 2,300 barrels a day and locked in $92 US for WTI. So all of these contracts are now 15-20% above where the market was. So fantastic timing for us. Really, it's just good fortune. We're not oil speculators. As part of our risk management program is to layer on some hedges and to get some predictability of the cash flows of the assets we're buying. So if oil continued to rally to $150, we certainly would be criticized of leaving money on the table. But for us, that just kind of locks in that we have a pretty good idea that of what our cash flows are going to be for the near term here. So the Viking acquisition was done in an area of this west central Saskatchewan. It's an area our company has been active in for since 2017. So for the last 5 years, we've been following industry trends, trying to get ahead of them, and building up this asset. At the time, we had 500 barrels a day of production. We're adding 4,000 barrels a day of production. So really ramped this area up as a critical core area for us. Brought in a lot of new drilling locations for our inventory for future growth. And we think we can keep this production stable in this core area for the next 10 years. Probably drilling about 3 wells per month. It keeps about 1 drill rig busy for most of the year. And we can keep this 4,500 barrels a day flat and continue to have it to be a cash cow. Rolling back just to the 4,000 barrels that we acquired, we're getting roughly 110 million dollars Canadian in cash flow off this asset. We'll reinvest 40% of that back into the drill bit to keep the production flat. So on a free cash flow, we're spinning out somewhere between 60 to 70 million dollars of free cash flow off this asset. You divide that into the 240 million dollar acquisition price, and we're buying this on a cash yield of roughly 27%. Very good investment. I think it's difficult to find a number of industries where you can buy cash flow at that kind of, I guess, high yield. And it really brought us, to the next level with investors. Got us through that 10,000 BOE a day mark. We're now 12,500, and can give us some critical mass in terms of operations, and key in terms of hiring. We can now run 2 rigs pretty much consistently, and as well gives us some critical mass on the stock market, where we're finding larger investors that wouldn't have had even heard of us a year ago now making some pretty substantial investments. On the drilling side, we've drilled now 32 wells. We put down the rig for the remainder of this year as we're completing our last wells. 32 wells drilled in the Viking area. We have 30 days of production data now on 12 of these wells, so we report on a kind of IP30 basis. And so for these first dozen wells, they're coming in on an average about 97 barrels a day. Our guidance and basically our type curve, so we're looking for about 70 barrels a day to kind of hit our growth targets. And so we're kind of 30-40% above that. We've been delighted with the drilling success here. We've had that hot rig going with the same crew, the same iron here for most of the second half of this year, and they've been banging out some great wells. So we're really happy with our drill results here, and we're reported on about the first half of the wells, and the newest wells that are coming in. I mean, they're coming in probably better than the first group. So look forward to kind of reporting back to our shareholders that could be going up as more data comes in. So these wells, I mean, they generate somewhere between a 80% IRR at $75 oil. If oil gets back to $95, where it was just not too long ago this summer, these are closer to 200% rate of return. Very strong returns here in the oil patch in Canada, and of course it helps to drill a better set of wells. So VIKING is working out very, very well for us this year. The other asset, we have the 2 core assets we have in Saskatchewan, is what we call the Oxbow asset. It's tucked into southeast Saskatchewan, a tiny little corner here in the province, butted up against North Dakota and the province of Manitoba. But in this small little area of Saskatchewan, we're certainly the big fish in the small pool. We've tied up most of the land. We have 290,000 net acres of land, and most of the production in this little area here. Probably more importantly, we've got about 2,500 kilometers of pipeline that brings our oil and gas to market here. Big part of the infrastructure, and so when we drilling our wells here, we're putting into a pretty big system here that has that keeps the operating costs lower, and actually some of our competitors use our infrastructure too, because we have most of the gathering system here too. So great place to grow from. I would say we're also looking for about 70 barrels a day out of each of these wells, but they cost a little bit less. They're kind of 15 to 20% lower cost than the Viking wells. A little bit lower decline, where we're getting about 40,000 barrels about cumulative out of each Viking well. We're probably at closer to 55,000 barrels out of each Oxbow well. So the cost less, produce more barrels, better economics. This is certainly our growth area, where the Viking areas will be our cash cow. The Oxbow area is where most of our growth will be coming from. We done 22 wells now here in the Oxbow area. The rig is done now here as well for the year, so we're just following the production of the new wells that are coming on. For the first 18 of these wells that we've drilled in this area, we're on target. It'd be nice to have a big outperformance like we have in the Viking, but here we're happy just to be on target. These wells have a little bit better economics than the Viking, so even on type curve, the return is somewhere like between 150% at $75 oil and as high as 300% more in terms of a $95 oil price. So great economics on investing here. And so walk you through, this is, as we say here in Canada, and I guess mostly the northern US, our hockey stick growth curve. And we've been able to ramp this up to where we're currently now about 12,500 BOE a day. And we're looking to get to 13,400 for next year. Achieving 13,400, which is a pretty a manageable jump from where we are now for next year. We'll generate somewhere about $320 million of EBITDA after hedging, probably 250 million. 200 to 250 million is kind of our target range, and there'll be $223 million of cash flow after interest, and so that equates to about $3.74 per common share. So I think there's certainly a lot of value behind our shares here in terms of cash flow and what we've built, and certainly where we expect to grow from. If I look at some of the analysts here in Canada that have us kind of matched up against our peer group, this is Canaccord Genuity and 8 Capital's peer group of the companies they cover from a research point of view. Of this group, we have the highest oil weighting at 96%, and that leads to the highest netbacks, where our operating netbacks are mostly above our peers, mostly because of the oil weighting. But when it comes to our enterprise value to debt adjusted cash flow, or enterprise value to EBITDA, the analysts have us trading at about 1 time. So we certainly be one of the fastest growing oil companies in Canada, but I also think we're one of the most inexpensive, and I probably correlated to some degree, as I think that we're just now hitting the radar screen for most investors. So you'll find my contact information here on the back. We now have Paradigm Capital has just launched research coverage on us yesterday, so the growing number of research analysts is now 5 in Canada, and First Berlin covers us from the point of view in Europe. So happy to pass on any of these reports if you guys want to contact me, info@saturnoil.com, or give me a ring, and I'm happy to kind of fill in some of the questions that you may have in the future. But for now, I'm happy to kind of answer some of the questions that have been brought on here online. So here I got a question. What price per barrel do you need to make your projected debt repayment schedule? And that's a great question, because we have roughly 72% of our oil production hedged out for this year. So I'll draw upon this slide. It's thrown in the back here, slide 24, but roughly 72% of our production is hedged for this year. Into next year, half the production is hedged. So we have some hedge production where we see some visibility of what we're going to get for cash flow on about half that production. So if we get down to even below $45, our hedge book becomes very valuable. We have the ability to pay back probably 100% of our debt. If oil went to zero, we'd probably just shut in all of our production, and our hedge book would then be valued about equivalent to our outstanding debt. So we've tried to take away as much volatility as the fact that end of the day, the debt's all paid off and our shareholders own the asset 100%, as opposed to our lenders owning the asset 100%. I got another question here that speaks to acquisitions. The question is, should we expect additional acquisitions by Saturn? I think it's quite possible. We have had a couple of acquisitions now that help increase our growth. And what we're really focused on is that when we do an acquisition, it has to be accretive for our shareholders. So the Viking is a great example of that, and I throw the slide back up here, where it increased our cash flow per share by 50%, and I don't think that that's being really reflected in our share price quite yet. But if we could do something like that again, and another acquisition that would get us even higher on a cash flow per share basis, we'd certainly consider it. This is an interesting kind of cycle going on right now, where Oil prices are very high. The price of oil assets seem very low, and there's a large arbitrage there. And certainly we've been able to capture that so far for our shareholders, and we'd likely do it again if we see the right opportunity. One of the next questions is, what is the driver for revaluation to Saturn, and how do we get back into our peer group here, where they're certainly trade, we'd be the lowest traded, with our Canadian peers here, one of the lowest valuations. I think time. I think certainly most people haven't heard the story. When I think if you're looking for an investment, I always think Canada is a great place to invest in energy. We've got a very stable government and very strong economy that's shaped around oil and gas. And then within this group, I mean, most people haven't heard of us. We've only been really kind of, making these pitches in the U.S. and to institutional investors kind of in the last 8 months. So it'll take some time and some marketing. So one last question, I'll fit it in here, and is, what are your 2023 milestones? Certainly, I think the biggest one behind us was showing the third quarter results that we got from the Viking acquisition. The next one is updating our shareholders in January to where production got to for Q4. We got 12,500 as our target as an average for the quarter. If we can make that, that's a huge win for us. We'll be reporting on more drilling results in January. Over half the wells that we drilled, we still need to report on, and I think we've got some great results to let our shareholders know about that. And then it's all about hitting 13,400 BOE a day. If we can hit that, Saturn will be a cash flow machine, and I think that'll be a big win for our shareholders, and I think that's certainly got to see us re-rated, and people will take attention to the cash flow positions that we've built here at Saturn. So that's it for the questions I have. I welcome you guys to contact me and get in touch with our company with any further questions, and as well as send me an email or reach out via telephone, and like to continue